All right. Good afternoon, everyone. Welcome to this afternoon webinar for MOHH Market Health Check, What's Next for Investor. Thank you very much for taking your time to attend today's session. My name is William. I look after the Singapore Institutional Business. Today with me, we have Tony, who is actually the head of multi-asset strategy. He's also the portfolio manager for your Global Balance Fund. Tony, to some of you, is not new. You probably know him before. He joined UOB Asset Management since 2008, bringing with him more than 31 years of investment experience. And he's certainly not new to Singapore. He's been in Singapore since 1996. What Tony will share today is he will share our view on the potential rate cuts in the US side, how the rate cuts will affect globally, particularly in Asia. Most importantly, how the change in the macroeconomic environment, in how your global balance portfolio will be positioned to take advantage of the change. Tony will spend the next 25 minutes of his time sharing our view, and we will follow up with 50 minutes of Q&A, and we all aim to finish today's session at about 4:15. Without further delay, I'll hand this over to Tony.
Thanks, William. Hi, everyone. Let me bring up my slides. Okay, so hi, everyone. So, I think these are interesting times in markets. I actually there's some really good things happening, I think, that I wanted to share with everyone. And, I think it has direct implications to how to think about your portfolio and what the outlook is. I also just think these are interesting times. I like talking to just, investors. I think there's some big things happening on how we should all be approaching our investing and how we manage our individual finances and so forth. So let me go through this. So, I actually find as I give these talks to our clients, that I don't even need a lot of economic slides like I usually go through. I think I find most economists around the world, most investors I speak to, most clients like yourselves I speak to, I think we all kind of are on the same page in terms of what we're seeing in terms of the economic data and the financial data. And I think the final discussion is just really how to interpret this all. And I find that there is a pretty strong bias across most investors to kind of interpret it all with a little bit of a negative bent. And, I'm interpreting it all with actually a very, very structurally positive bent. And so I think it makes for an interesting discussion. And I want to share, some thoughts on how I think everyone should be thinking about what we're seeing in the global macro environment. So I have a simple slide here, but I find my presentations, I spend a lot of time on the slides. So let me just go through some of these key themes that we're talking about. So the first part is just a simple idea about that the hard part is over, right? And I think we're all kind of aware that the recession risks that were so high last year, with the vast majority of the world's economists calling for a recession last year, that surprisingly didn't happen. And most economists around the world thinking that inflation really couldn't improve unless you had some painful experience and rising unemployment to get wages down and so forth. And yet we're sitting here and actually everyone's kind of thinking inflation looks like it's on track and going to improve, and that we're not talking about rate hikes this year. We're talking about rate cuts and how many we might be getting. And, that in itself is just a really big positive thing that is somewhat miraculous. If we spoke a year ago, if I laid out a view that we're going to avoid a recession, we're going to have miraculous inflation coming down to normal, it would seem almost too good to be true. But that's where we're sitting here today. On top of that, I think I encourage investors to even just take a further step back and think about what we've done to overcome to get to where we are. And I would highlight that. I mean, the first part is we've overcome COVID, right? I think it took a while to get through all the after effects of the inflationary problems and so forth. But we're sitting here, and it kind of looks like we survived it. Economically, keeping people employed, managing people's health as best as possible. I think as we're sitting here now, we're thinking, okay, I think we did an okay job dealing with a really difficult global event. And then even bigger picture, I would say the global economy and the world's financial markets have not been normal ever since GFC. Ever since GFC, there was a lot of deleveraging that was going on, especially in the developed markets like the US and Europe, that had led to all this sort of subpar, sort of stagnant growth for over a decade. And the only thing that was sort of keeping things up was a lot of policies that had never been tested before, with a lot of QE and 0% interest rates. And for the most part, we're sitting here now and thinking, oh, it looks like it kind of worked. We got through that really sluggish period. Growth is looking much more resilient now. We have normalized interest rates, and we're having an economy that, even though interest rates were raised in the most aggressive interest rate hikes that we've had pretty much in history, and the economy withstood it, and the global economy is still on its feet and looking more normal than any time since GFC. So, that's this first point. The hard part's over, but I think people are a little bit understating just what an achievement it is to get here. Um, the second kind of main theme that we're highlighting that I think sort of just builds on this for the coming year is over the last year, we survived, we didn't get a recession, inflation improved, but the economy wasn't that normal. It's simply what I would describe. It was that global goods, global trade, global manufacturing, they were all kind of in recessionary conditions. I can show you the charts on it. But it was services around the world that was keeping things afloat. And as we're looking at the data now, what I find encouraging is some of the things that were really kind of at trough levels look like they're bouncing back. So in particular, that would be manufacturing and the manufacturing surveys. They look like they're about to get back into expansion territory. On Friday, we get reports around the world, and most of the regions are getting close to getting to expansionary. They're not necessarily forecasted to get there yet, but it could be we get some of the first confirmations on Friday if we get some good news. And so if we have manufacturing and global trade, and we have that kind of normalizing, that adds to sort of just better economic breadth. And that's good news for markets, because markets are kind of more tied to the goods and the manufacturing economy than they are to the services, right? Like restaurants, they're not listed on the stock exchange, but goods sectors tend to be. And therefore, if those are rebounding, that's going to be good for listed corporates, it'll be good for earnings, and it would lead to better breadth, not only in the economy, but in the stock markets. Because I'm not sure everyone was following, but one of the key issues that was a little bit worrisome last year is that markets ended up doing okay, but it was, overly led by just a few sectors, and in some ways just a few companies, right? Everyone talks about this magnificent seven, how it dominates the market cap and accounting for such a big part of the market performance. But I think we see better sectoral performance, and I think we see better regional performance. Many of the regions that I think had been left behind outside the U.S., I think they're starting to catch up. And even just in the last month or so, we're seeing really good performance in Japan. We're seeing it in Europe. They're making all-time highs. Within Asia, we have some parts of the region like Taiwan, Indonesia, they're making all-time highs. I think Asia is kind of lagged behind a lot of what we've seen, and I'm thinking that the coast is looking clearer and that Asia is going to start to catch up. So anyway, that's a second major theme that I think is a pretty constructive one. And then this last theme is, it ties to our higher for longer paper that we've put out. I don't know if everyone saw it, but if you go to our website, you can find our thoughts on a white paper of how to think about the fact that the inflation and interest rate environment is going to be changing over the next decade compared to where we've been in the past decade. But really, kind of one of the takeaways is, we discussed in that paper that, higher inflation has the potential to turn into something like the 1970s, which was very problematic. But it also has the potential just to be more of just a normal inflationary environment, which I argued was like the 1990s or the 2000s. And if so, a normalized inflation environment usually actually leads to a more vibrant economy than in a sluggish subpar growth environment like we've had ever since GFC. And I have a list now on how many ways the current macro conditions remind me of the 1990s, and that was an exciting time to be investing. I think in hindsight, when I say this reminds me of the 90s, everyone immediately thinks to the dot-com bubble and thinks that oh, that didn't end very well, and don't really necessarily think of it as a very attractive time for investing. But I'll share with you, my stories, and my biggest takeaway is it was a time where things were pretty rosy, and they were rosy for years. And I give the first example I always give is just Alan Greenspan was the Fed chairman of the U.S. Fed. And he made this famous comment at the time. I don't know if anyone still remembers this, but he called the market irrationally exuberant when it was like getting frothy in the 90s. But interestingly, he made this comment in 96. And already at that point, markets thought the markets were overly irrationally exuberant. But they stayed that way for the next 4 years. And each year, things got more frothy until like 2000, when, I think the dot-com bubble got kind of ridiculous. But the current environment, there's a lot of parallels. I have a slide on this, but the whole AI thing reminds me so much of the dot-com thing, except that AI makes a lot of money, and dot-com never made any money for years after that. Um, so anyway, I think this all adds up to an environment where I think both stocks and bonds look pretty good. So, our first takeaway is for your portfolio. I see fairly attractive prospects. I expect solid performance, and I think there's less downside risk. Even then, I think individually, I know as I talk to friends and, even just retail clients that we have at UOB, I'd say most, as I explain this, most seem to buy it that, yeah, maybe we should be thinking kind of positively about this environment. I would say the biggest holdback I hear is just that, well, it feels like I've missed it already, right? I'd love to buy Nvidia, 2 months ago, but now it feels like it's hard to go out and buy. And so I have some charts on that, and that just kind of making the point that it feels like markets have gone so far, but really we're pretty much at the same level we were 2 years ago. It's just that we've gone through a pretty wild journey where we fell so much in 22 and recovered so much in 23. And I would argue you should really be thinking that we've missed it all. As a matter of fact, it's more that we've been on pause for a couple of years. Okay, so that's my big picture. And, if all we had was 5 minutes, I just want to make sure our clients, hear this view from us, hear this potential. Of course, there are some risks out there, and I can go over them. But quite honestly, and I talk clients, everyone, the risks are all that's on people's minds, and the upside potential of this environment, I think, is getting a little glossed over. So I just wanted to highlight it. How about let me just show some charts just to reemphasize these broad concept points that I've highlighted, right? So firstly, on the economy, we talk about how, at the end of 2022, there was evidence of things slowing, and it was reasonable for many economists that when you look at, the top leading indicators, they were looking like we were going to get down into contractionary territory. But surprisingly, in 2023, there was a lot of resilience. And in fact, by the second half of 2023, economies around the world were actually getting a bit stronger. In the US, the GDP numbers were actually surprisingly, shockingly strong in both the third quarter and the fourth quarter of last year. And so I think as we sit here now, not all economists have withdrawn their recession forecasts, but for the most part, I think it's a pretty broad consensus now that those indicators that were pointing to a recession last year, they haven't completely switched off, but they're getting pretty close to switching off. And given the economic momentum we've had over the last 3 to 6 months, I think most economists would agree it does not seem reasonable to be forecasting a recession at this point. And also just structurally, usually recessions get triggered from like some big excess, like a housing bubble or some big imbalance in the economy. And it's other than the fact that interest rates could have caused a recession. If they haven't by now, then it doesn't look like they're obvious triggers that should be triggering a recession. So for the most part, I think now we look clearer. And if you look, so at UOB, our house view is it's probably not until at least 25, and we'd more likely call maybe 2026. And at this point, we just don't see something on the horizon to justify a recession call. And then, when it comes to consensus forecasts, it's just a table of numbers. But I would say, 6 months ago, these numbers were looking weak. But, month after month, economists just keep upgrading their forecasts really region by region. And then the other thing that we highlight is just, the progress on inflation. We kind of focus on sort of the 3 and the 6 month trends, and we think they're really coming down. And also, when we break down the components, we tend to argue that if it wasn't for rents, everything else looks like we're almost back to 2% inflation, and that even the rent numbers look like they're lagging the real economy. And in the real economy, it looks like rents have already come down, and that'll be just a matter of time before the CPI data reflects that as well. So the recessionary story looks good, and the CPI story looks good. We do sort of a breakdown of where we think these key sectors are going. And we end up with, I'd say roughly our house view is inflation 2024 probably gets down to a 2.5% level, which is not the Fed's target of 2%, but really it's close enough that we would expect the Fed can back off the level of interest rates they have. And I get to it in the latest slide, but basically we're forecasting 2 to 3 rate cuts for this year. That has been a little bit lower than fewer rate cuts than I think the market had been talking about, and I can get into this discussion more. But I think actually within the last few weeks, I think the market is sort of settling on a view of about 3 rate cuts, and if that's where consensus is getting to, that would be a range we would be recommending as well. Then there's another part of the economy that I think is kind of exciting to see. So, in my presentation, my first bullet point is that, hey, as investors, we should start to realize that, hey, the hard part's over. We've dealt with the recession risk, we dealt with inflation. And I think you're starting to see it in the data on the consumers too. So, this is a chart of consumer confidence in the US. And these numbers have been very low. They were kind of almost like GFC type low levels. The consumer is very sensitive to bad inflationary pressures and has been really negative on the economy. And in the last couple of months, these numbers have really started to pop. And I think that's a potentially bullish sign that if your average consumer is starting to feel more confident about the world and feels like this isn't sort of GFC level badness, I think that's potentially going to imply, uh, you know, more optimistic spending outlook, and patterns that you can see throughout the economy. I think what's happening for the consumer is the wage data has actually been quite strong for the last couple of years, but inflation has been so high the consumer hasn't felt like he's benefited. Whereas now wage growth is still pretty good, but inflation's down. That makes real wages actually stronger than we've seen in a couple of decades. And if that holds, and the consumer really starts to feel like his real wage growth is stronger, I think that has positive implications for the economy. I think this also has positive political implications. I think if there's anything that's going to save us from a Trump presidency, I think it's this view that I think economists see the economy really looks surprisingly good. But I think, the man on the street doesn't necessarily feel it yet, but we're starting to get indications that he might finally be feeling it. And if the man on the street sees what economists see, then I think then that's probably going to help Biden in the end. But I think we all know it's kind of scary how potentially realistic it could be that Trump ends up as president. I have a few more consumer confidence numbers. This one's put out by a different group, but it's also been improving. And, I highlight that I think for the man on the street in the US, confidence usually comes from like obvious price numbers they see all the time, like things like gas pump prices. And in many states now, we have gas pump prices back below $3 US. And I think that's kind of psychologically pretty encouraging for many just consumers out there. There's another interesting aspect where these consumer confidence numbers look really weak, and even with the pop, that's good, but it's still kind of historically abnormal levels. But it is somewhat biased by, I think, the way Republicans fill out this form. So within the consumer confidence numbers, they break out what is your confidence by party. And so Republicans think the economy is worse now than they think it's twice as bad as in the middle of COVID when there was 15% unemployment, and they think it's worse than the GFC. So I think, Republicans in this hyper-partisan environment really can't see anything good while there's a Democrat president. I think Democrats also have a little bit of bias, but they mostly look like pre-COVID, they kind of had this sort of 80% level of confidence, and they're kind of at that now. It kind of looks more normal, but um, I think even in their numbers, they can be a little bit biased. But anyhow, the bigger point is I do think politics is overly suppressing the confidence numbers, and I actually think it's a little bit better than even the headlines look. So I had this point about market breadth. Let me just show just this theme just kind of quickly. So, I think it does boil down to the ripple effects of COVID. After COVID, in the midst of COVID, we were all staying at home buying goods from Amazon. And then we opened up and we all went to restaurants and focused on services. And you can see this blue line is goods, and that went negative for a while. And that kind of left manufacturers who had fairly big inventories after COVID. When we all slowed down the buying, they were left with big inventories and they stopped their orders, and manufacturing around the world went into contractionary territory. But where we stand now is that maybe this chart looks a bit small, but if you can track this blue line, it's the U.S. number, and so you can see under the red line is manufacturing in contractionary territory, but it's picking up, and it looks like it's about to cross the red line again. And it's not only the U.S. Let me just show you one more. This is sort of a leading indicator on where manufacturing goes, because this is looking at new orders and it subtracts out inventories. And so, given your level of inventories versus orders, tends to be sort of an indicator where manufacturing is going. And so this is leading us to believe that we're probably going to be getting better numbers on it. And so this trend is pretty consistent around the world. I was just showing you the chart on the US. We're kind of seeing similar patterns elsewhere. And it boils down to they're all still below 50, which means contractionary, or so most are still below 50. But they're all getting better from where they were, both on a monthly number and a 3-month average. And some are getting close to breaking into expansion territory. And so we argue that's good because that affects the listed companies more, and that should help earnings growth be solid. And DOB, we kind of argue that valuations are pretty full, but if earnings are going to grow by 10% this year, then the market can grow by 10%. And that's generally what people are forecasting around the world. We're getting forecasts about 11% earnings growth in the US. We get stronger double digit in Asia and China. Japan's close to double digit. Europe's at least okay. But I think, this is all encouraging enough that I think should be pretty supportive of market performance over this year. And I do think this becomes my guide on what to expect out of markets. So, 10 to 15% return is about what I think global equity markets might be able to do, which isn't that. Some clients tell me that I sound more bullish than just 10 to 15% up. But I put in the perspective of, yeah, but it's 10 to 15% up without having a lot of scary overhangs. Like last year, I think if you spoke to me, I would have highlighted that we thought we should get back invested. We thought equities can deliver returns, but it was a bit more of a scary call. I felt like, yeah, things could go up 20%, but I could also see the scenario where we could end up down 20%. And it just feels like that upside downside risk is just much much better, and it makes it much easier just to say, yeah, let's just get invested. We should be overweight equities. I think we're going to get decent returns. And so the last theme is just about this higher for longer theme and what it means to be like back in the 90s. So one part of where I try to remind people of how the 90s went is the first part is on interest rates. So if you look at this blue line here, this is the Fed funds rate in the US. And in 1994, they had a very sort of sharp hiking period. And, it was actually 94 frequently gets compared to 2022, except 2022 was even just much more fierce than 94. But, in 94, fund managers everywhere were talking about what a hard year it was. And then the way it went for interest rates is the Fed did admit they probably, tightened, and inflation looked like it was coming back under control, and they could normalize the interest rate level a bit. But it mostly boiled down to just a few cuts. And it was roughly three cuts that they did over that period, and then they kind of mostly held interest rates through most of the remaining years, and then maybe hiked them a bit more. Oh, they cut them a little bit during the Asia financial crisis, and then raised them towards the end of the cycle before you had your next recession. But I would say something like this is what I would be expecting for interest rates. So I think we can get a few rate cuts, but I wouldn't be expecting that much. And I think then we end up plateauing for a while until we get to end of cycle, because it's a pretty healthy economy. It's pretty employment's pretty full, and we shouldn't necessarily be expecting too much in the way of rate cuts. And so that's one part of where it feels like the 90s. How about this other chart I use when I try to encourage investors who feel like they've already missed it? I highlight that. But the big thing is what happened was we fell so much in 22, we recovered in 23, and that if you look at earnings, they kind of grew over this period. And so we're left with a market that's not that much more expensive than December 21. And earnings now are better, and we're expected to get another 11% earnings growth in the coming year. And I have a similar chart on this. I didn't include it in this deck, but if you look at the Magnificent Seven, what's interesting is the stock market of the index of the Magnificent Seven is up roughly, I think it's like 6 or 7% compared to that period. But earnings are up 30% compared to that period. And therefore, their valuations, if you think they're expensive now, they're actually much cheaper than they were in 21. And so again, I just think, we need to sort of have a reality check on how I think we're all looking at this. And I think a lot of investors I speak to have kind of bearish. Missing out is one part of it, but also just the fact that valuations seem scary. But I think there's an underappreciation how much earnings have grown for a lot of these things that have driven it. I have a bunch of stories that on how this decade kind of reminds me of the 90s. I mentioned that like AI, biotech, and what's going on in the auto revolution. Those are just really exciting major changes that, reminds me a lot of the dot-com era. In biotech, I think this group probably knows it better than most. But when I talk to clients, I think nobody's aware of a lot of these exciting trends, whether it's mRNA, CRISPR, the GLP-1s. The GLP-1s, they made Eli Lilly's market cap increase into one of the top 15 market caps in the world. They're essentially rivaling the Magnificent Seven in performance right now. And, I ask clients, I think we were at a conference yesterday, who knows what a GLP-1 is? And like two people raised their hand out of like 150. I imagine on this group, probably people more know, but if you don't, I think it's going to be a big deal. It's the anti-diabetic weight loss drug that's just having remarkable success, and it's kind of revolutionizing the way people are thinking about dealing with it. And from the stock market term, everyone's looking at this and saying, "Wow, the addressable market of this is huge. Everyone's going to be on this." And who doesn't want to lose weight? And there's Morgan Stanley put out a report. They did all these studies, and they said people who are on these GLP-1s, they're not only their diet is more under control and not overeating, but what they're eating has improved. They're not eating candy. They're eating more vegetables, and also has just these compulsive effects, right? The Morgan Stanley report showed that people are drinking less, they're smoking less, and they're gambling less when they're on these drugs. And now I think there are additional surveys out that the cardiovascular improvement in people who are on these is very significant as well. So anyway, it's I guess I don't mean to like going on about this one little drug, but what reminds me about the 90s is just exciting stories like this get rewarded. And I think we're going to be in a few years where you're probably need to be hearing less from me. I don't think you need to hear macro recession risks for a couple of years. I think what you'll need be exciting to hear about is like analysts who are talking about what's going on with autos, what's going on with the EV revolution and how automation is taking over. Obviously, the AI story is through the roof. But I think we're just almost scratching the surface in terms of how AI is going to change things. The number of stories that are coming out about how companies are using AI. I was just reading about one of the largest retailers, online retailers in Europe, how they're doing. They have an AI dialogue that's doing 2 million conversations a year with clients. And Anyway, and then I don't know if you've all heard, but at UOB, we have these AI funds where the AI is helping to pick the stocks. And we have this Asia ex Japan fund that has suddenly become pretty much the top performing fund in the world, given the AI support they're going. And I think, we have some scientists that I think have really taken a good approach on it. But anyway, my main point being just, I think we really need to be open-minded about how much productivity might be generated out of all this. The 90s also had a normalized inflation and rate environment. There was a surprisingly continuous expansion where we just kind of went on year after year, things getting better when it always felt like it was, too good to be true year after year. I think there's the 94, 95 parallel regarding interest rates and, frothy market that stayed for years. I tell my team, so I was around in the 90s. I guess I'm an experienced old timer now. But a lot of people on my team don't even really have that much pre-GFC experience. And I tell the story of Abby Cohen. So she was the first female head of investment strategy at Goldman Sachs. And she just kind of made a name for herself because she said year after year, the market outlook looks good. And everyone looked at her as sort of over Panglossian. Oh, she thinks everything, she doesn't understand how things can turn down. But then year after year, she was proven right. And then everyone started to listen to Abby Cohen. And there's a story of Henry Blodgett. He's just, a .com analyst, and he made this outrageously bullish call on Amazon. And then it immediately went to sort of double in the next few days just because this one analyst came out and started hyping this stock called Amazon. And and I already told the Greenspan story of irrational exuberance. But anyway, I'd say just to be aware that if things can have some legs to this positive environment, just to get a little perspective of how it might feel. So then finally, we're seeing positive things for Asia. So one, if you just look at the data, it's been picking up better in Asia than the rest of the world, and I think that correlates that global trade has turned positive and global manufacturing is looking better, and that I think speaks well for Asia. Structurally, we highlight that if this is like the 90s, Asia did great in the 90s until it hit a financial crisis due to the U.S. dollar imbalances and so forth, but obviously it was doing great for a number of years before it got to the problem. And I would liken that, if you're in a more normalized interest rate world, Asia's stronger growth becomes more valuable, right? When you're in a 0% interest rate world, you can invest anywhere that has slow growth. But when your hurdle rate is higher, then the Asia's better growth gets to get more of a premium. And I think actually Asia ex China is doing pretty well. Taiwan did great last year. Korea was rocking for a while, and maybe got a little sideways towards the second half of the year, but Indonesia's been doing solidly. India is one of the most attractive stories. And now you don't even have to say Asia ex Japan because Japan's doing great. So I actually think the Asia story already is pretty solid, and it does boil down to China. And I'll just say the bottom line on China is we do think the structural problems are probably going to last a couple of years. It's going to take a while to sort of rebalance an economy that has been overly focused on property driving their growth. But really, I think the markets are too negative on China. China has a lot of positives as well. Everyone's kind of ignoring that for now. And I also think cyclically, um, China's growth is actually getting better than it was 6 months ago. And so we're not overly negative on China, but we're underweight it in our portfolios, but we do like Asia ex China. Okay, so I think those are some of the key themes we wanted to highlight. Maybe I have a final slide here on just the performance of the fund. So the fund's been doing well. We ended, I think, let's say in 2023, I think we ended up, I believe the number was 7.8% up. This is as of January. January added another 0.77%. February looks like it's adding as well. And then, 2022 was painful, but I think we're making up a big part of that drawdown. I think we're getting close to, I think we can fully recover in 2024 to make up those losses that we had from 22. Okay. I think those are my main points. I'll stop there. William, do you want to have any additional thoughts or coordinate any questions?
Yep. Okay. Thanks a lot, Tony. Thanks everyone for your time. For those of you who have questions, please feel free to key in or type into the Q&A. If you look at the bottom of your screen, next to the word participant, you can see a label say Q&A. So feel free to type in your questions. Just going to see whether there's any question coming in. Or maybe while we wait, Tony, I will ask you one question to kick off the ball rolling. I'll start from the back, given that you ended up the session with the performance of the fund. I think in 2022, there was a significant drawdown in the global balance fund for this for our client. Perhaps you could take this opportunity to share a little bit about the reason behind the drawdown and how are we positioned after that?
Yeah, so I think many I had the chance to talk over last year about how challenging 22 was. We would start off by saying, for global markets and for sort of a balanced fund, actually 2022 is probably the worst year on record in 100 years. Which is surprising, right? Because if you're, just living through 2022, we didn't have a recession, wasn't like it was the end of the world. It didn't feel like it should be worse than GFC. But that combination of what happened with interest rates and the stock markets, where bond funds were generally down around 20% and equity markets are down around 20%, it adds up for a balanced fund to be, one of the most challenging years in history. And I highlighted that, we had reasons to be concerned. We were underweighting equities, we were underweighting fixed income, we were trying to hedge some of our interest rate risk, and we were shortening our duration. We felt like we were doing so much to try to reposition the portfolio in 2022. But nevertheless, the pain came through, and I think for the full year we were down about 10%. So we haven't fully made that 10% back yet, but I think we're getting closer. And if we can have some more performance like recent months, I think we're going to get there. And then, of course, just in terms of like the benchmark, our target is 3.8% per year, and certainly we can do that on a year-on-year basis. But I want to make up the amount that we didn't get back in 22. So yeah, that's the main story on 22. And then I would just say for the coming year, the fact is, I don't mean to overpromise Being bullish, I don't mean to overpromise the returns, though. I just think it's just a more confident, steady outlook. From bonds, we're expecting roughly 5 to 6% type returns, and for equities, we're thinking more like a 10% type return. And that still gives us pretty good opportunities in a fund like ours.
Okay, well, thanks a lot, Tony. I think there's a question that came in through the Q&A side. This is in relation to Japanese equities and fixed income. So the question says, given the complicated macro factors such as Japan entering into recession, while market expects BOJ to tighten rates on stabilizing inflation, what is your view on Japanese equity and fixed income under this environment?
Okay, so yeah, we like Japanese equities. We're investing it in your fund. We don't have a big overweight in it, but a house view is we would like to lean into Japanese equities, and it's largely for structural situation that is improving, and also for the fact that the corporate profit trends look good, and also we have a view that global manufacturing is getting better, and that Japan tends to have a big industrial sector that participates in that. So we like the backdrop for equities. And we think that while some of the economic data has looked a little questionable, for the most part, we think it's going in the right direction. Part of the question also is referring to the fact that given that things are going well, the interest rate situation and monetary policy is probably going to normalize at least a little bit. And if so, that becomes a little bit a headwind for fixed income. So we're a little bit more cautious on Japanese fixed income, and it's already an environment where yields are, low and negative. That we don't really have a lot of it, and we don't plan to get into it too soon.
Okay. Oh, thanks for that. There's no question coming in at the moment. Maybe while there's no question coming in, maybe I'll just ask another question then while we wait. I know in the session, Tony, you painted quite a fair bit of optimism in the way the market is going forward, right? You said the hard part is over, and then you did also highlighted a fair share of things to look out for. Perhaps you could take this opportunity to kind of summarize what are the overall opportunities that you see amid all this change in economy trend. Most importantly, the geopolitical tension that we are witnessing now, together with the fact that we know that it's going to be a rate cut. It's a question of timing and how much, right? So with all this packaged in, where do you think the opportunities are really?
Yeah, okay, that's a good question, and yeah, and specifically, I would say I'm conscious that compared to where we've been the last few years in the midst of COVID and the recession risk from last year, this seems like the risks that we're talking about do not feel as big and as existential as they've felt in investing in, really for many years now. So that's part of where the optimism comes from, but that doesn't mean there isn't any risks. And so I think you're right to highlight, William. The first one is the geopolitics around the world are really complicated, and it's there's so many sort of worrisome trends that's one area that we put near the top of our list. We're worried about the Middle East and the Red Sea. We're still worried about the Ukraine war, and then I think the U.S.-China relations are probably going to get even more messy in the midst of a political election. And if Trump comes into be president, then I think there are risks around trade policy around the world, and I'd be worried about the implications on some of those fronts. But for the most part, the geopolitics for most years usually are not the main driver of the economies and markets. Usually, as long as the economies and markets are driving, the geopolitics, even if they're messy, don't necessarily interfere. But you have to watch because big wars obviously can affect markets. So I think it's worth highlighting that risk. Oh, and maybe just one more risk. I think the best case scenario now really is that we are not getting a recession. But we're not completely out of the woods. There are, historical examples where employment stayed strong for so long, but then actually, things started to slow down. And it took a while before everyone realized it. And so, I'm conscious maybe that's a trend we get, but I'm mostly pretty confident now that things look like they're holding up.
Okay, thanks a lot, Tony. I think there's one more question just came in. I'll just read it to you. This is in relation to climate change, right? So the question says, does UOB see the market rewarding investor for factoring ESG consideration in their investment? How does UOB position the portfolio in this aspect?
Yeah, so we think there's a lot of evidence that companies with good ESG practices are rewarded. We look back at longer term data and we see the evidence of that. And also just, like a key part of ESG is just good governance, and good governance, is just a basic thing we would look for, whether or not there was a global movement to highlight it. And so then, even on our ESG teams, we score everything on ESG terms, and we highlight, when there are bad blowups in various companies, we highlight that's why they were rated so low on a governance score, on a practice score, and we think it's prudent to try to avoid those types of companies. And just so you know, I mean, we don't pound the table on highlighting how we do ESG and everything, but it's in our DNA. It's everything we do. Your portfolio is a pretty highly rated ESG portfolio, and we just think it's right to do. And we'd be picking these as better securities to be investing in, whether or not a client said it had to be an ESG mandate or not.
Okay, thanks a lot, Tony. I think in the interest of time, and also we don't have any more questions coming in as well. We say we end at 4:15, it's about 4:18 now. So I think we're going to end the session. But before you go, I would like to take this opportunity to thank all of you for taking time to attend today's webinar. And most importantly, we also want to take this opportunity to thank you for giving UOB the privilege to manage your Global Balance Fund for MOHH and all the investors here. And thanks for your time. And do help us to fill in the feedback form at the end of today's session. Once we end this session, Zoom will send out a feedback form to you. It will help us to understand a little bit about what you value, how you see we can do better in the future, so that the future webinar will be even more useful for all of you. All right. Otherwise, thank you very much for your time. Thanks, Tony, as well, everyone.
Thanks, everyone.
Thank you.